metals. First, Hindalco's subsidiary Novelis reported a fall in Q3 profit, but Novelis has made some interesting comments about what lies ahead. Mihika joins in with the details and, more importantly, the commentary for the quarter and the quarters ahead. Mihika.
It was a weak quarter, but this was already indicated by the company. We've seen a net sales see a 4% uptick on an annual basis. However, the company's adjusted EBITDA was down 19% to 367 million, but this is a level that was indicated by the company in the preliminary business update. And the adjusted EBITDA per ton was also down 19% to $406, and net income saw 9% fall to 110 million. And if we exclude the special items, which was basically the impact on the Sierre plant of the company due to the unprecedented floods, then the net income of the company is down 32% on an annual basis. In terms of volumes, that flat road product shipments were at 904 kiloton, around the same level as a year before, but that's a 17% fall on a quarter-on-quarter basis, and the volume decline was largely led by lower volumes in the automotive as well as the specialty segments. And the fall in EBITDA per ton was mainly due to three factors as per the company: higher scrap prices, lower volumes, and an unfavorable product mix. In terms of their con call takeaways, well, in terms of their demand outlook, global beverage packing and aircraft demand remains strong, but there's weak macro environment for the auto segment in Europe, and China is also seeing slower growth in the same segment, but they do expect a seasonal uptick in their specialty segment. When talking about the impact of the Trump tariffs, Novelis management has also said that there's a marginal initial impact until the company gets an exception, but last time the company had received an exception for its intercompany plant material movement, and in the medium to long term, the higher premiums will benefit the spreads as well as the margins of the company. And lastly, when they talk about guidance, well, Novelis does expect Q4 earnings to be stronger on higher sales and better scrap usage, and they believe that the impact of the elevated scrap prices has bottomed out, and better CAN prices from January 2025 will benefit margins of the company. They also stated that the Bay Minette project will still give double-digit return on equity despite the scrap spreads coming down, and the annual capex guidance is on the lower side of $1.8 to $2 billion. And lastly, their net leverage will peak out at 3.5x versus 2.9 times currently.
Okay, so Nalco is the other one though. We were speaking about it briefly earlier, Mihika, and you track the company. We're just trying to understand what the internals show us in terms of why this is looking like a strong quarter.
A very good quarter. We've seen revenues grow 39% and EBITDA and net profit both more than tripling. But the interesting fact is that even though Nalco is one of the largest integrated bauxite, alumina and aluminium players, 57.5% of its Q3 operating profit this quarter was from its chemical business. Now, when you see a deep down, even in Q3, revenue uptick in aluminium business was 12%, but the revenue growth in their chemical business was 78%, and now the segment contributed 49% of their Q3 revenues versus 38% a year ago. And the operating profit also was a huge turnaround. It stood at 1,287 crore rupees compared to just 217 crores a year ago. And we'll dive deep down to break down the chemical business, but these are the numbers that we've seen right now.